Welcome to our reading, Demand and Supply Analysis, The Firm. Now, our first LOS says calculate, interpret and compare economic profit. Now, what we're going to do here is compare accounting profit and economic profit. Accounting profit, of course, is what appears in our income statement in our statutory accounts. And, of course, that is our sales figure minus our accruals-based expenses, i.e. explicit costs, to arrive at net income. Now, economic profit is going to take that accounting profit, i.e. the revenues and the explicit costs, and also deduct implicit costs. Now, what are these implicit costs? These are opportunity costs. Now, what opportunity costs do we have? Essentially, we have the opportunity costs to the providers of finance. In other words, we're going to deduct charges for the provision of finance. So notice our implicit opportunity costs are the return on the owner's capital, i.e. the amount of return on the equity, and also the opportunity cost of the owner's time. Well, what would that be? Opportunity cost is always the cost of the next best alternative. In other words, it would be the earnings that the owner could generate operating on the next best job rather than running this business. Now, in other words, therefore, our economic profit is accounting profit minus the implicit cost, minus the investors' required returns, if you like. Now, we talk about normal profit when economic profit is zero. I want you to make a linkage between economic profit and NPV. NPV in corporate finance, net present value, is a form of economic profit because it's generated when, essentially, we discount the cash flows at the WACC and we get a positive NPV, which means the returns exceeded the weighted average cost of capital. In other words, you can also think about economic profit as ROE being greater than R. So if we exceed the investor's required returns, we generate economic profit. Now, normal profit is simply economic profit that equals zero. In other words, we're not saying that zero economic profit does not mean zero accounting profit. We'll still have a positive accounting profit even if our economic profit is zero. It will have an effect on equity values. Well, of course it will, because if we're earning economic profits, we're exceeding the investor's required returns, and therefore prices should rise. Economic rent, and it's the perfectly inelastic supply one we really want to talk about here. You can see when supply is perfectly inelastic, you get economic rent. Now, economic rent is a form of abnormal profit. A good way of thinking about this is to think about professional sports players. Let's take a Premiership soccer player, football player. Now, or maybe an NFL football player. They get paid massive salaries. But if they weren't operating as a sportsman, what would be the next best salary they would get? Now, without wanting to cast aspersions, a lot of them are not very bright, so we'd probably have to get a very low-paid job. That means there's going to be a lot of economic rent. The economic rent is the salary that they are receiving compared to their next best salary. So with inelastic demand, you get a lot of economic rent. There's only a finite number of people that have the skills to operate in the NFL, to have the skills to operate in the Premiership. So they generate a lot of economic rent. Now, if you're low skilled, so there's an awful lot of supply is virtually elastic for your demand set, notice we have no economic rent. In other words, the salary you get paid is the same as the salary you would get in the next best alternative. Now, we're asked to calculate and interpret our demand curves at this point here. And first of all, we're looking at perfect competition. And we're going to come back to this in the next reading and talk about it in more detail. Notice, in perfect competition, we have a horizontal demand curve, which means demand is equal to price, is equal to marginal revenue, and is equal to average revenue. Let's just define a few of those terms. We know what demand is, the demand for the good and service. We know what price is, the price paid per unit. What is marginal revenue? The additional revenue that the firm receives from selling one extra unit. And what is average revenue? It's the total revenue, i.e. price times quantity, divided by quantity, the average price per unit. And notice they're all the same because we're looking at a horizontal demand curve. We're going to refer to these firms as price takers. Now, in the next reading, we'll come back to this and explain exactly why our line is horizontal in perfect competition. Now let's talk then briefly about imperfect competition. We're going to refer to these as price searchers because they've got to search out the price to maximize their profits. Now notice we've got a downward sloping demand curve and as a result a downward sloping marginal revenue curve. Why? In order to sell more goods, the firm is going to have to reduce prices. Now that means demand slopes downwards because price per unit falls. But of course if we sell at a lower price, that affects all of our units. We can't charge different prices for each unit that we sell. So notice marginal revenue has a steeper gradient than demand. Marginal revenue is going to decline as quantity increases because firms must cut prices to sell more. Again, we're going to come back to this when we look at monopolistic competition in the next reading. Describe the factors of production. All I'm really going to say here is these are the inputs to a firm's production process. So they're what they use to produce finished goods. So it's going to be land, labour, capitals, materials, inputs to the production process. Often in economics, we're just going to look at two major factors of production, labour and capital. Okay, so we can ignore materials and land for this. Okay, so describing a production function, we're saying the quantity is a function of labour and capital. So we've got total output on our y-axis and we've got quantity of labour. So we're actually looking at a labour-based production function on our x-axis. So notice, first of all, we've got increasing marginal product. Now let's talk about what that means. Marginal product is the additional output generated from employing one extra worker. So what we're saying is output is increasing at an accelerating rate as we employ extra workers in this area. Now notice then the gradient begins to drop and we talk about marginal product decreasing. So as we employ one extra worker, output is still increasing, but it's increasing at a diminishing rate. So we talk about this as being diminishing returns to our factors of production. Notice beyond a certain level, as we employ more labour, we actually get negative marginal product. So what that means essentially is the output is actually declining for each additional worker that we hire. We're also asked to describe the total cost for our firm. So we've got a few phrases here, TC, TVC and TFC. Let's start with TFC. Total fixed cost. We need to be able to define a fixed cost. A fixed cost is any cost that does not vary in line with sales. Now we're going to argue therefore that fixed costs are unavoidable in the short run. However, in the long run there is no such thing as a fixed cost because you can close your business down. So we're going to have certain fixed costs. Anything that does not vary as output changes. A variable cost by definition is items that do vary or costs that do vary in line with output. So total variable cost is the variable cost of producing a unit times quantity produced to give us total variable costs. Notice total cost itself is just the total fixed cost plus the total variable cost. Now, a few more costs that we certainly need to be able to describe for our exam. And what we've got here is marginal cost, average total cost, and average variable cost, and average fixed cost. Let's start off with average fixed cost. Now we said that total fixed cost does not vary over output. However, average fixed cost is going to fall as output increases because average fixed cost is simply total fixed cost divided by quantity. So the bigger the quantity you produce, given that fixed costs are not changing with quantity, your numerator is static, your denominator is increasing, and therefore average fixed cost per unit declines the more you produce. So companies that produce with very, very high fixed costs, such as the oil industry, electricity, etc., normally companies that are very infrastructure dependent, very, very big fixed costs, are going to be dependent on selling massive volumes to reduce the average fixed cost per unit to the minimum amount they possibly can. Okay, now average variable cost is simply total variable cost divided by quantity. So the average variable cost of producing a unit. Average total cost, nothing more than average fixed cost plus average variable cost. So average total cost is the total cost to the firm of producing a unit. Now let's look at marginal cost. Marginal always means additional. So the marginal cost is the additional cost you would get from producing one extra unit. Now first of all, note that if the marginal cost curve is below the average variable cost curve, as you produce one extra unit, average variable cost will fall. Why? Because the marginal cost is less than the average, so by producing that one extra unit, it pulls the average down. The marginal cost will therefore intersect, let me just put my intersect point on our diagram, there we go. The marginal cost will intersect with the average variable cost at the minimum of the average variable cost curve. Once marginal cost is above average variable cost, if we produce one extra unit, it will cause average variable cost to increase. So if marginal cost is below average variable cost falls. If marginal cost is above average variable cost rises. So the minimum point on the average variable cost curve is where it intersects with marginal cost. Now the same is going to be true of average total cost. If the marginal cost is below the average total cost, producing one extra unit will push cost down, so average total cost falls. If marginal cost is above average total cost, then producing that one extra unit will cause the average to rise. So again, essentially, the marginal cost curve passes through the minimum point on the average total cost curve. Break even and shutdown. Now remember, we said that in the short run, fixed costs are unavoidable. Whether you produce 100 units or 0 units, you have the same fixed costs. And as a result, they're irrelevant for decision making in the short run. So notice we've got our marginal cost curve here. The additional cost of producing one extra unit. Now what we're going to essentially argue on this is if marginal cost is below average variable cost, and if price, and this is the key point, if price is below that point where the two intersect, this point here, if price is below that point there, then the firm should shut down. Why? Because price is less than, so if we're in our area here, so if price is below P2, then price is less than average variable cost per unit. It's worth shutting down because you can avoid the variable costs in the short run. Shut down. Okay, now, if price is between P1 and P2, whilst the firm is not profitable, it will continue to operate in the short run. Why? Because by definition, in this area, your price is bigger than average variable costs. Now, we talk about price minus average variable cost as being contribution, because it helps contribute to pay off your fixed costs. So we will continue to operate. Now, of course, it's not until we get to a point P1 and above that we'll start to make profits. P1 will break even because price will equal average total cost. And beyond P1, of course, price is above average total cost, so we'll start to make a profit. So really the key point for your reading is to note, I was trying to highlight that, is to note these 2 points here, and to note that it's relating to this distance between P1 and P2. And we're saying in the short run, price is above P2 but below P1 because they give you positive contribution and help pay off some of your fixed costs, and because you can't avoid those fixed costs, you would continue to operate. In the long run, of course, you need to cover both variable and fixed costs, so you would shut down. And of course, then the key is to say above P1, then we're covering all of our costs, fixed and variable, we'll make profits. Of course, below P2, you're not even covering your variable costs, and therefore the firm would shut down even in the short run. Economies and diseconomies of scale. Well, remember what we said. What we're looking at here, notice, is the long run average total cost curve. Now, what we're going to argue here is that in the long run, there is no such thing as a variable cost. Because let's start that again. In the long run, there is no such thing as a fixed cost. Everything is variable because essentially you can change the size of your firm or even shut down. Now what that means is, notice we get lots of different short-run average total cost curves for differing sizes of the firm. Now notice there will be a level that minimises the long-run average total cost curve, and there it is, and that is known as the minimum efficient scale. That is the long-run efficient level to minimise the firm's costs. We talk about quantities below the minimum efficient scale as benefiting from economies of scale. In other words, as output expands, economies of scale kick in and essentially cost per unit start to drop. What are economies of scale? Economies of mass production, if you like. If you're producing large amounts, essentially you get good deals with your suppliers, so supply cost comes down, you have less idle time in your firm, you get more utilization, so costs come down. Now notice, if we go above the minimum efficient scale, we start to suffer from diseconomies of scale. Now I always say this is a bit like too many cooks spoiling the broth. Essentially, you start to get bottlenecks in the process. Now, another thing, of course, that you get is red tape. You might have noticed that if you work for a big company, a lot of your time isn't actually spent doing anything that's productive. Instead, you spend a lot of time doing kind of appraisals, reverse appraisals, 360-degree appraisals, to and fro. You have to fill in forms to get a new pen from the stationery cupboard. In other words, all of these things reduce your productivity and lead to diseconomies of scale. So there is some point that minimises the long-run average total cost, some size of the firm that minimises the long-run average total cost, and we call that the minimum efficient scale. Okay, now we need to do, try and get the slide to move on. That's better. We need to now describe break-even and profit maximisation. Now, let's just say break-even straight away. I mean, this is just a very simple point. Break-even is when total revenue equals total costs. Okay, so we break even. Now, again, rather unsurprisingly, if total revenue is greater than total costs, you make profits. And that's all it's simply saying here. So notice economic profit is made when the total revenue is greater than the total cost. Economic losses are made when the other way around. So revenues are less than total costs. That was easy. Right, okay, we're talking about perfect competition here. Now these readings are completely overlapped by the next LOS. So I'm going to tell you about it now, and then I'm going to tell you about it even in more detail later on. Now I think the important thing really to note here is profit maximisation for a firm is when, let's get my pen up, where their marginal revenue equals their marginal cost. And that's true of all firms. What is marginal revenue? The additional revenue they get from selling one extra unit. And what is marginal cost? The additional cost of producing it. If revenue is bigger than cost, it makes sense to produce more units. If marginal revenue is less than marginal cost, it makes sense to cut back, until you end up at an equilibrium point that maximises profit, where marginal revenue equals marginal cost. Now, we've got P1 on here, which is our demand curve, which is equal to marginal revenue, it's equal to average revenue, and it's equal, of course, to price. So this firm will operate where marginal revenue equals marginal cost. There we are, that's that point there. Marginal revenue now equals marginal cost. Extend the line downwards, and that gives us the quantity we'll produce. Extend the line across, and that gives us price. Now notice, at this particular quantity, average total cost is below price. So we've got price here, and we've got average total cost here. The difference between price and average total cost, of course, is economic profit. And we've shaded that area in blue. But the problem with perfect competition is there are no barriers to entry. So if we generate economic profits, we're going to attract competitors. And as we attract competitors, that's going to force market supply up. And as market supply goes up, if market demand is unaffected, down comes price. So price is eventually going to drop until we end up at this point here. Now notice at this point here, price equals average total cost. In other words, no economic profits are being generated. So we talk about the short run in perfect competition, where you can generate economic profits, but due to low barriers to entry, we argue that in the long run, no economic profits can be earned. Notice that demand curve is horizontal. It's perfectly elastic. I will explain why in the next reading. Now, we said in the short run we will make profits if price is above average total cost. So we make economic losses, i.e. we do not satisfy investors' required returns if price is less than average total cost. So you could get economic losses, and presumably the company would go out of business in that scenario. And as it goes out, as firms go out of business, then of course industry supply would fall, price would go up until we end up at a price level where price equals average total cost and firms can continue to operate. Imperfect competition. Now, of course, the key here is to note that the demand curve is downward sloping, and therefore marginal revenue, the additional revenue that you get for selling one extra unit, has a greater gradient. It's not the same as the demand curve anymore. Now, profit maximization is exactly the same, where marginal revenue equals marginal cost. So let's just put that point on. Here we are, it's marginal revenue, and there's the marginal cost curve. So there is our profit maximization. Now extend the line down, that gives you quantity. Extend the line up until it hits the demand curve, and then across, and you get price. Now, of course, the total rectangle bounded by my yellow line, price times quantity, is total revenue. Now, of course, with that quantity, extend up until you hit the average total cost curve, and there is that point there, and across, and you get total cost. So our total cost area is our white rectangle here. Again, notice here that price is at this point here, average total cost is below it, so price is greater than average total cost, and therefore economic profit is being generated. Can you sustain this? Well, again, it's going to depend on barriers to entry. If you're a monopoly, the answer is yes, you can probably sustain it in the long run. If you're not, and you don't have high barriers to entry, competition will enter. As competition enters, that will cause industry supply to increase, prices to drop until the economic profit is eroded. Again, why our demand curve is downward sloping is because we produce differentiated products rather than homogeneous products. But again, I will explain that more in the next reading. Profit maximization in the long run. Minimum efficient scale. I think we've said this already. Look, what we're simply saying is, in the short run, the firm may operate at P1. But remember, in the short run, the size of the firm, the infrastructure, is fixed. In the long run, there is no fixed element, because you can expand and contract the size of the firm either by increasing your productive capacity or reducing it. So, at P2, notice, our long-run average total cost curve is minimized, and that gives us the efficient size of the firm. The point where it minimizes the long-run average total cost curve is the efficient size of the firm. And we're asked to distinguish between short-run average total cost, where the size of the firm is fixed, and long-run average total cost curve, where the size of the firm is variable. Okay, decreasing cost and increasing cost industries. Let's just have a quick discussion about that. Okay, now let's imagine we've got an increasing cost industry. Now, we're starting off at point 1 on our diagram, and we're going to argue that there's no economic profit there. For whatever reason, the first thing that happens is demand shifts. Now, that demand shifting, higher demand means higher price. If we had no economic profit at point 1, when we shift to point 2, we're now generating economic profit. So at point 2, price is greater than average total cost. Now, we're in an increasing cost industry here. What that means is, as we generate these economic profits at point 2, we're going to attract competition. As competition comes in, that's going to create more demand for resources, i.e. factors of production. That's going to increase the cost of the factors of production, which is going to increase the firm's average total cost. Notice then, as the firm's cost of production increases, the supply curve shifts out to point 3. Now notice, at this new equilibrium price, it's above the equilibrium price that we originally had at point 1. So what's happened in the long run is the costs of the industry have increased. Why have the costs of the industry increased? Because the additional competition that was attracted when we were generating economic profits increased the output in the industry. It put an increase in the demand for resources used in the production process, increasing their costs and therefore increasing the average total cost of production. Hence, we're an increasing cost industry. As quantity in the industry increases, the average total cost increases, so we get a long-run supply curve that essentially kinks upwards. Now, with the decreasing cost industry, it's a similar idea. So we start off at point 1 in equilibrium, no economic profit. Demand shifts again, so we move to point 2, where price is above average total cost, so we're making economic profit. This attracts competition. Now, as quantities start to expand, what we're going to argue is resource producers are going to benefit from economies of scale because they're now supplying more materials, etc. This reduces the price of the factors of production in this case, meaning essentially that when supply shifts out, when supply expands because of the competition, we'll end up at point 3. And at point 3, notice the equilibrium price is below our starting equilibrium. Why? Because average total costs have fallen. Okay. Why is this the case? Economies of scale in the supply of the factors of production. Right, we're asked to be able to calculate and interpret total, marginal and average product. So total product is just the total output of your workers. So one worker produced 8 units, 2 workers produced 20 units, 3 workers produced 26 units. Remember, our marginal product is the additional output essentially produced by employing 1 extra worker. So if 1 worker produced 8 units and 2 workers produced 20 units, the marginal product of the second worker must have been 12 units. Let's have a look at the marginal product from going from 2 to 3 workers. We go from 20 to 26 as our output, so the marginal product of the third worker is 6. Let's look at going from 4 to 5 workers. Notice from 4 to 5 workers, output goes from 30 to 32. So the marginal product of the 5th worker is 2 units. Average product is a nice easy one. It's simply total product divided by the number of workers in this case. So total product for the 6 workers, they produce 33 units. In other words, they produce 5.5 units per worker, and that is our average product. Now, notice with our marginal product, remember this is the output per worker, that essentially as we start to increase labour, initially marginal product starts to increase. In other words, we've got increasing returns to labour. This often comes as a result of things like specialisation in the labour process and the learning effect of labour. So we can actually segregate our labour and each can focus on a specific task and therefore become more efficient. Now, of course, typically when you employ labour beyond a certain level, you'll start to see diminishing marginal returns. Diminishing marginal returns simply mean as we employ more workers, whilst marginal product is positive, the marginal product starts to decrease. So notice when we employed 2 workers, the marginal product went from 8 units to 12 units. So we had this increase. But then once we employed 3 workers, the marginal product went to 6, then 4, then 2, then 1. So the output per worker was still, the output of an additional worker was still positive, but it was smaller, essentially. So we talk about experiencing diminishing returns to labour. Now again, we need to be able to discuss marginal and average product here. Notice if the marginal product, the output produced by employing 1 extra worker, is greater than the average, if you employ 1 extra worker, the average will rise. Now, if the marginal product of 1 extra worker is less than the average, then employing that 1 extra worker will cause the average to fall. So again, it's worthwhile noticing that marginal product will intercept at the highest point on the average product line. Now, our importance particularly of this slide is to notice the relationships between our marginal and average product curves, i.e. the output per labour, and the cost curves of the firm. So let's start when labour is below L1. Now notice when labour is below L1, in other words, we're kind of in this segment here, below L1. Notice the key thing to notice is the marginal product is above the average product. Okay, so notice here's our marginal product in this area, here's our average product. So our marginal product is above the average product. So if we employ more workers, essentially the average product will increase. And you can notice, therefore, that the average product curve is increasing. Okay, now that is true. Notice as well now when we turn our attention that when to the cost curves, that in the same scenario, the marginal, that essentially when marginal product is maximized, marginal cost, the cost of producing one extra unit, is minimized. Okay, so again, the key point is this point here, actually I think I'll do it in red, this point here is linked to minimizing the marginal cost here. There we go. Now, if we go beyond L1, notice that marginal product now starts to diminish. The additional output per worker is going to start to diminish. It's still above average, so the average product is rising, but it is diminishing. Now, what that means is your marginal cost will start to rise. So notice our marginal cost is now, our marginal product is coming down, and our marginal cost is rising. Until we reach a point where marginal product is equal to average product. We know if we expand labour beyond that, because the additional output per worker is less than the average output, then average product will start to fall. Notice this point here is inherently linked to the point where marginal cost hits average variable cost. What we're saying is, if we employ that extra worker, our marginal costs will now be greater than average variable costs. Okay, so let's talk about profit maximizing amounts. We're asked to determine what a profit maximizing input is. Now notice here we're talking about marginal revenue product. On the previous slides we were just talking about marginal product. Marginal product was the output that you could get from employing one extra worker. Marginal revenue product is the dollar revenue, the monetary amount you can get from selling that marginal product. Okay, so the addition to total revenue from selling the additional output from, in our case, the marginal product from employing one extra worker. Now, of course, we know as we increase each particular input, so for example, labour, whilst output increases in absolute terms, it's going to increase at a diminishing rate because we know marginal product will eventually start to fall. So we see diminishing marginal returns to labour. So to maximise our profits, we're going to use an additional amount of labour until the marginal revenue product, the additional revenue we get from selling the output of that extra worker, is equal to the cost of employing that worker. In other words, we're generating no profit or no loss. So in the labour market, we should continue to hire more workers until the marginal revenue product of labour, the output or the monetary value that we get from selling the output of employing one that is produced by one extra worker, is equal to the wage that we pay them. Now, what we've got here is three factors in our production process. Okay, now in order to minimize overall costs, the marginal product divided by price of A must be equal to the marginal product of B divided by price B, the marginal product of C divided by price C. Now again, these are the different factors of production. So maybe MPA is labour, maybe marginal product of B is the output of additional capital, maybe C is the output caused by labour, capital, better materials or something like that. Now the idea is, and I think it's easier to see this via the third bullet point, if the marginal product of labour divided by the price of labour is greater than the marginal product of capital divided by the price of capital, then we're saying we're getting more output per dollar spent. So it makes sense to keep on employing labour. Now, as we keep on employing labour, its marginal product will decline, diminishing returns, until eventually we end up in a scenario where the marginal product of labour divided by the wage is equal to the marginal product of capital divided by the price of capital. So in other words, we should keep on employing these different factors of production until the marginal product divided by price is equal for each factor of production. And that's the end of this reading.